Hello everyone. So in today's video we're going to understand a very important concept in financial markets, that is we're going to understand what are bonds, and then we'll also do a comparison between what is the difference between bonds and shares as well as what is the difference between bonds and debentures. And finally we're going to understand the different types of bonds which are issued by different entities. So to understand what are bonds, let's take an example. Let's say you have Tata Power which wants to borrow or which requires 500 crores because it wants to set up a new power plant. Now in order to raise these 500 crores, Tata Power has multiple options. So for example, it could issue shares. However, let's say Tata Power is like, we don't want to issue shares because we don't want to dilute our ownership or we don't want to have new owners in the company. So basically shares is no longer an option for Tata Power. Secondly, Tata Power could approach the bank and let's say take a loan of 500 crores. So it could go in for a bank loan. But Tata Power is again reluctant, let's say, because the process of taking a bank loan requires multiple documentation and formalities and it is not interested in going through that route. So the other alternative which Tata Power has is that it could borrow by issuing bonds. So bonds in essence are basically debt instruments, that is they are instruments which enable different entities to borrow money for a specified duration of time. Now, which are the entities which can borrow money via bonds? So most importantly, you have the government as well as government agencies which can issue bonds. So that is the first set of entities. And then you have corporations, in particular large corporations which issue bonds so as to raise money from investors. Now any holder which invests in a bond gets returns via interest payments and he's also returned the principal on the maturity time or when the bond matures. So to understand this, let's take an example. Let's say there is a bond which has a face value of 10,000 rupees. So basically to purchase a bond you need to pay 10,000 rupees and the tenure is 3 years and it carries an interest of let's say 8%. So what this bond is doing is that any holder of this bond is in the first year going to get 800 rupees as interest payment. In the second year he will again get 800 rupees as interest payment, and in the third year the bond is going to provide 800 rupees as the interest payment and it will also return the principal amount of 10,000. So basically any holder in a bond gets regular interest payment as well as the principal on maturity. So this is the broad concept of bonds. Now if you were to compare bonds with shares, so the first key difference between bonds and shares is that shares are equity instruments, that is shares provide ownership to an investor. So anyone who owns a share of a particular company is a partial owner in the company. On the other hand, bonds are debt instruments, that is anyone who owns a bond is a lender to the company and he's not a owner to the company. Now if you talk about the return between bondholders and shareholders, so the key mechanism through which shareholders get return is determined on the price of the share in the future. So let's say someone who's invested in a company bought a share of a particular company for rupees 100 and in the future there is a very good chance that the share price could be 120 rupees. So the profit of a shareholder or an equity holder depends on this difference or the difference in the share price. So that is the mechanism or that is the return which a share owner gets. On the other hand, the return which a bondholder gets is through periodic interest payment as well as the principal on maturity. So in context of shares, the returns are less structured because they depend on the share price. So the profit depends on the share price, which is itself variable. But on the other hand, bonds tend to provide a structured payment pattern, which is they pay periodic interest payments and principal on maturity. So clearly bonds are thereby less riskier instruments, but if you talk about the chances of earning a greater profit or return, it is clearly more in context of shares. Now, another key difference between bonds and shares is in context of bankruptcy. So, let's say if a company becomes bankrupt and the different investors or lenders in the company have to be paid, in that case also, bond holders are prioritized when it comes to payment over both equity and preference shareholders. Now, this is because bond holders are essentially lenders or creditors to the company, and in cases of bankruptcy, creditors are prioritized over owners. So, the sequence in which different entities are compensated during bankruptcy is that you have bond holders which are paid first, then you have your debenture holders, and after that, you have your preference followed by your equity shareholders. So this is the sequence in which different entities which have lent money to a company are paid in case of a bankruptcy of a company. So these were the key differences if you talk about, or key comparisons between bonds and shares. Now, on the other hand, if you talk about bonds and debentures, so what is the difference between bonds and debentures? So, at the very outset, one must understand that there are very small differences. In fact, the differences are such that it's very hard or it becomes very blurry between bonds and debentures. Now, the reason is that firstly, these both are debt instruments, that is, they enable entities to borrow money. However, they can be differentiated based on which is the entity which is issuing these instruments or usage, or whether this instrument has any form of security backing this instrument. So specifically, if you talk about bonds, bonds in general, the issuer of bonds either provides a specific asset as a form of security, or the issuer of a bond in general has a strong institutional credibility. So for example, if you have Government of India which is issuing bonds, so these bonds are not backed by specific assets, but they have a strong institutional credibility because it is the government which is issuing these bonds, and the government is almost never going to default on its payments. On the other hand, if you have, let's say, a company such as Tata Power which is issuing bonds to raise funds, then Tata Power is in most likely scenario going to provide some form of security while issuing these bonds as a form of collateral so as to protect the money of investors. On the other hand, if you talk about debentures, in most cases, debentures are unsecured. That is, the company which issues debentures in general does not provide any security, and debentures are in general issued on the reputation and credit worthiness of the company. So any investor who's purchasing a debenture does because he believes that the financial prospects of the company are good and the company has a strong reputation. So now, if you think about it, the distinction between bonds and debentures is actually blurred. Why? Because firstly, they are both equity instruments, and both the instruments can have some form of collateral or security backing them. Why? Because you could have a bond which is backed by a form of collateral, or it could not be backed by a form of collateral. On the other hand, you could have debentures which are backed by collateral, or they could not be backed by collateral. So this distinction thereby becomes a bit hard, or it becomes blurred. But in general, if you think about in day-to-day economic parlance or in day-to-day economic usage, when the term debenture is used, it is generally used in context of corporate borrowing. So when you in general see the word debenture, you can think of it as basically debt instruments which are being issued by corporates. On the other hand, the term bonds in general is used to symbolize government borrowing. So while bond is a broader category which also includes corporate borrowing, but in general it refers to government borrowing. On the other hand, you must remember that governments do not issue debentures. So debentures are instruments which are issued by companies, and bonds on the other hand refers to instruments which are issued by the government. Now if you talk about the different types of bonds, so you can categorize bonds firstly on three broad parameters. So first is the entity which is issuing bonds. So you have government bonds, that is bonds which are issued by government. For example, you have your treasury bills, and then you have your government of India bonds. So these are the some of few examples of bonds which the government issues. Then you can have bonds which are issued by corporate entities or large corporate entities. For example, you could have bonds being issued by Tata Power or Reliance Industries. Thirdly, you could have bonds being issued by local governments for multiple purposes. Say you could have a local government, issuing a bond to fund infrastructural development. For example, we know that the Pune Municipal Corporation has issued bonds, so as to raise funds for water supply projects under the Smart Cities mission. So you could have even local governments issuing bonds for infrastructural development as well as other purposes. Now the second way in which you can categorize bonds is based on the way or the manner in which they pay interest to the investors. So you could have a bond which pays a fixed interest, or the interest rate is fixed every year for the investor. So let's say, like the example we took, the bond could have a fixed rate of 8% per annum. So it is paying every year 8% to the investor. Then you could have a bond which has a floating rate or a variable rate. So let's say there is a bond which is paying a rate of repo rate plus 2%. Now because your repo rate changes based on the rate which RBI determines, so the return which this bond is going to offer is going to be variable, or it's going to be floating. The third type of bond based on interest payment are your zero coupon bonds. So we've discussed zero coupon bonds when we are talking about money market instruments such as treasury bills. But for clarification again, so zero coupon bonds are the bonds which do not pay any interest payments, and they are bought at a lesser value and they pay the full value on maturity. So you could, let's say, have a zero coupon bond being issued at 9,000 and paying the full 10,000 on maturity. The third way you could differentiate or categorize bonds is based on convertibility. By convertibility, we mean that you could have a bond which gives an option to the investor to convert into shares in the future. So these are your convertible bonds. On the other hand, non-convertible bonds become bonds which cannot be converted into shares in the future. So these are the three broad categories of bonds. In addition to this, you have certain special type of bonds which we're going to discuss in the next subsequent set of videos. For example, we're going to understand what are inflation index bonds, then we'll talk about masala bonds, green bonds, and so on. So these are the other types of bonds which are going to be discussed subsequently in the playlist. So for today's class, this is all we wanted to discuss. If you like this video, follow and subscribe to the channel for more concepts in regards to UPSC economics. Thank you so much for watching.